Before we get into this special deal review episode, here are the required disclaimers that remind you that all investments carry risk and that none of this commentary is intended to be financial, tax, or legal advice. This program is intended to display how experienced LPs analyze a deal and question a sponsor. Now let's get to it. Hello, passive investors. I'm your host, Jim Pfeifer. Today's episode is part of our special deal review series where we bring syndication deals to a panel of experienced limited partners to analyze and discuss. The goal? To equip you with the tools and insights to confidently step into passive real estate investing as a limited partner. One of the best ways to do that? Review deal after deal after deal to understand what separates a great investment from a bad one. This time, we've invited Paul Bennett from AAA Storage Investments to present one of their latest deals. Paul, thanks for joining us.
Jim, thanks for having me.
And joining me on the panel are our experienced LPs, Paul Shannon and Chris Lopez. Paul, Chris, great to have you here.
Thanks for having us.
Hey, Jim. Happy to be here.
Together, we'll break down the deal, ask the tough questions, and expose any red flags we see. If you're a passive investor looking to sharpen your skills, this is the perfect chance to learn from experienced LPs and gain insights for your own investing journey. So here's a review of the format. Paul will have 10 minutes or so to highlight the growth fund at AAA Storage Investments. We've asked him to just highlight the deal. We're assuming that everyone watching has a handle on AAA's track record, has reviewed this deal, and watched the webinar. After about 10 minutes, the LP panel will pose questions to Paul for about the next 15 to 20 minutes. And then we'll let Paul go, and our panel will discuss the deal amongst ourselves. As a reminder, this is called passive investing, but your work begins with evaluating all of the underlying documents and information. Okay, Paul, let's do it. Let's get an overview of your deal.
Super, Jim. Thanks. And Paul, Chris, thanks for being here as well. Normally, this is about a 45-minute presentation. I'm going to cram it into 9 or 10 minutes. I'm going to divide this into 3 parts. Talk a little bit about AAA Storage so you have a little bit of our background, but hopefully, as Jim said, you've seen that information. Talk a little bit for a minute about our overall strategy, and particularly as it applies to the fund. And then thirdly, really focus on the terms of the fund and the opportunity itself. AAA Storage was founded in 1993. We've been in the real estate business for over 30 years. During that entire period, focused on self-storage and office industrial flex real estate. Jim mentioned the track record. We're really proud of it. Over 90 full-cycle deals in those 30 years, which obviously crosses lots of different cycles in the real estate markets. Across those 90 full-cycle deals, we have returned a 19% IRR on average to our investors, and that's across 6 million square feet of real estate, $450 million of exit value. We previously did only single property syndications. In 2022, we made the transition to a fund model, put this first fund together in 2023, launched late in that year. Our strategy at AAA is to focus on city skirt markets that are supported by major metropolitan SMAs. To be really clear, we don't build the multi-story boxes that you see popping up all over America in self-storage today. We stay focused on single-story drive-up self-storage. It is the most resilient asset class in all of real estate. It allows us to make data-driven decisions. It's an asset class where there is lots of market data available on the competitors that exist in a particular market, what the square foot per capita is from a demand standpoint or a supply standpoint in the storage market. So it's a very predictable, resilient asset class. Today, the average occupancy across the country is about 91%. And the demographics really support strong future growth. The other product that we build is Office Industrial Flex. It has occupancy today that's currently outpacing the general industrial category. It's referred to as the small industrial, buildings under 10,000 square feet. We have a very diverse tenant base in that product. And today, if you look across the country in Office Industrial Flex real estate, really vacancies hover in the 4 to 6% range. So very, very strong product. As a strategy, we stay focused on yield on cost and development spread, which are 2 metrics used in the development business to really measure the potential for value creation in the development process. In our portfolio, our self-storage properties average about a 9.5% yield on cost, and the Office Industrial Flex products about 100 basis points higher than that at around 10.5%. If you look at most multifamily or retail development deals, they would be very pleased to get a yield on cost in the mid to low 7% range. So this is a product that really drives value creation in the development process, which is why we focused on it. Let's transition and talk for a minute about the fund itself and the investment opportunity here that our panel is going to give their opinion on shortly. AAA Storage Growth Fund 1 is a portfolio of 8 properties. We may add a 9th property, depending on how the last part of the capital raise goes. The properties are located in Austin and San Antonio, Texas, as well as Houston and the Tampa, Sarasota markets. The portfolio will be allocated 60% to self-storage and 40% to office industrial flex. We did break escrow late in 2023, so we already have a property that's completed phase 1 construction and is in lease up. We've got 4 properties that are in construction currently and will complete phase 1 construction in the first quarter and a half of 2025. We've got a 7th property that will start construction in January, and the last property that the fund will develop will start development and construction sometime in mid-2025. Our strategy in the fund is to develop, stabilize, and sell these assets in order to drive the highest time-valued returns for our investors. The fund is not structured to provide cash distributions on a quarterly basis. If you stop and think about it, our mission is really to create value in the development process. And during lease-up, before we get a property to stabilization and full value, it really isn't generating excess cash flow to be distributed to investors. However, we will distribute cash as we exit each property during the course of the fund. So our average time to start from first shovel in the ground to complete stabilization of a project is somewhere in the neighborhood of 4.5 to 5.5 years. So we would expect to be sending proceeds from those first dispositions back to investors at about the 4.5, 5 year mark in the fund. And the fund really began construction of its first property in November of 2024. I think a couple of other things to note that are important is that AAA Storage, the sponsor, will be the largest LP in the fund. We currently have about $6 million of our capital committed as an LP in the fund, and we're also the guarantor on all of the property level debt. So we have a significant financial stake in the success of the fund, which gives us excellent alignment with our investors. Let's talk for a minute about the terms of the fund. Our stated minimum in the prospectus is a $200,000 minimum investment. However, for Passive Pockets members and investors, we've lowered that minimum to $50,000. The fund has a 1.5% management fee. However, via side letter, which we'll execute with each Passive Pockets investors, we're going to lower that management fee to 1%. The fund does offer a 7% preferred return. To be clear, as I've already said, we don't anticipate quarterly distributions from operations. That pref return is an accrued return that gives a priority distribution in the waterfall when we exit a property. The back-end split or the promote in our structure is 70-30. Again, via side letter, we're going to modify that for Passive Pockets investors and make it 75% to the investor and 25% to us as the sponsor. The fund will close to investors at the end of March 2025, so we've got about 1 quarter left in our capital raise process. And our target return to investors is 3 times your equity and a 19% internal rate of return, which happens to basically be equivalent to what we've produced over 90 full cycle deals in our track record. That should give you a pretty good overview of the fund. I'd be remiss as I sort of end this quick summary of AAA Storage Growth Fund 1 if I didn't point out to you that obviously the information we've covered here is summary in nature. It doesn't give you everything you need or should know to make an investment decision. That can only be done by the offering memorandum. So please, if you have interest and you want to explore this further, reach out to us or download it off the Passive Pockets website, but be sure to read that offering memorandum incomplete. Jim, that pretty much does it for me. Hopefully I covered enough ground to give you guys good fodder for some good questions.
Yeah, thank you very much, Paul. That was perfect. That's what we're looking for. Now we're going to transition into the next part where we're going to have our experienced LP panelists come up with questions and ask Paul, and he's going to respond, and then we'll go until we don't have any more questions. So this time I'm going to start with Chris Lopez. Why don't you start us off? Your first question for Paul.
Yeah, well, great presentation there, Paul. So one of the questions I had is, I know you said you're primarily IR and equity driven focus, which I like as an investor. And I know in the PPM and other stuff I've read are going to be mostly from the sales of the property. Do you guys plan on distributing cash flow once the property is stabilized and leased up to LPs, or is that cash flow going to be reinvested to push the majority of the exit towards the sales price?
We don't have the right by prospectus, Chris, to actually reinvest. And so in the event that we hit stabilization on a property, and for one reason or another, if you look at our track record, we have held properties in different markets for different lengths of time. Right now, we think the opportunity is there to exit these properties as we approach stabilization. And if we do that, there probably won't be any cash flow. If cap rates are elevated and there's some pressure in the market when we get ready to sell a property, we're not going to sell it just for the sake of selling it. And we have our own vertically integrated property management function that today manages a portfolio of 25 assets that we develop prior to launching the fund. So we have the capability to hold an asset a little bit longer term. And if we do that, we'll absolutely distribute the cash flow to the investors.
Okay. And if you do single digit, double digit, what's the cash on cash range you project?
Cash on cash returns, if we were holding a mature asset, should be somewhere in the 6.5 to 8.5 range.
Wonderful. Thank you.
While we're on this topic, I want to jump in and ask a question, Paul, because in the offering documents, there's some conflicting information, I think, and I'm not sure how relevant it is on a deal that is development because most of the payout comes at the end. But in the pitch deck, it shows that the waterfall is, the first part of it is 7% preferred return, and the second part is return of members' capital. But in the PPM, it's opposite. It shows the capital is returned first and then the pref. So can you tell us which is correct? And then also, does it really matter because most of the return of capital and the pref are all going to come in the back end when you sell these things anyways?
Gosh, I'm sorry for that confusion. I'll need to go back and look at that. We certainly didn't do that intentionally. No, it should be the pref is returned first and then return of capital. And then as a manager, we have a catch-up provision on the pref that's been distributed we get 30% of the amount distributed to the investors on the pref side. And then for passive pockets investors, it's a 75-25 split. But you're right, Jim. It really is not going to matter. Any cash that comes out of the fund will have to go through that waterfall, whether it's a distribution from operations or proceeds from a sale. But our strategy would indicate almost all the bang for the buck is going to come as we sell these properties. Now, I didn't mention this, but if you look at the average time frame of 4.5 to 5.5 years, and you look at the sequence in which we've started construction on these properties, we expect to fully exit the portfolio by year 7 or 8. Now, obviously, we don't have a crystal ball and we don't control every aspect of that, but that is the strategy. That's the plan. That's what we're going in trying to accomplish.
I definitely have some questions about the PPM and the deal specifics, but I first have a question more about the macro. As I was doing some research, I looked at some data from Real Capital Analytics, and I'm just going to read this verbatim. After peaking at $172 per square foot in the second quarter of 2022, self-storage valuations declined for 6 consecutive quarters to an average of $139 per square foot in Q2 of 2024. So my question is, by investing now, are we catching a falling knife, so to speak, or is now a good time to reconsider and invest in self-storage?
It's a great question, Paul. There has been pressure in the market. The pandemic created a really artificial market, an artificial amount of supply. If you think back, everybody in the world was cleaning out bedrooms to make offices out of them, or they were bored and they were at home, they were cleaning out their garage. And occupancy in the industry went as high as 97, 98% in a lot of markets. We've come down off that sort of back into reality. Occupancy's now settled at around 91, but there has been, because of the rise in interest rates, which then affected home sales and moving, which is about 25% of the demand in the self-storage market. What you've seen square foot rental prices depressed as particularly the big REITs and the bigger institutional players fight to maintain occupancy. So that's where you see that decline from $172 a square foot to $139 a square foot in the market. All of that has also depressed development activity. And so we believe that what we're going to see is a dwindling new supply coming into the market over the next 2 or 3 years with a demand curve that's pretty consistent. You've got a lot of dynamics in the demand curve. You've got the boomer generation, which I'm a part of, downsizing, kids are gone, moving to a smaller house. You've got the millennial and Gen X generations that are just reaching household formation. That's the period of life where all of a sudden they're moving, they're doing things that require self-storage. So the demand numbers look pretty good. And at the end of the day, I'll be a little bit tongue-in-cheek. At $139 a square foot, if you bought it at $172 or you're building it for $180, you got a problem. Our average cost per square foot to land a project on the ground is between $100 and $105 a foot. I don't love $139 a foot, and I think we'll see values begin to move in the other direction, but we can make that number work if we have to.
Excellent. Thank you.
So this is a very nuanced question regarding the PPM, Paul. But I was reviewing that this morning and saw that a reference to a lot of the properties being held through a DST or Delaware Statutory Trust. And I'm very familiar with DSTs, but I'm not familiar with the structure of a fund using DSTs to hold properties. Can you explain how that works together?
Boy, that is a nuanced question, Chris. Congratulations for probably asking that. I've not been asked that question by any investor. So
that was my next question too. So we're on the same page, Chris.
It's a great question. So we're testing something in this fund that we don't know will hold up from a tax standpoint or not. But if you do know DSTs, they can allow you to do a 1031 exchange out of the asset. And we're curious to see if we can ultimately get to a structure where we could allow investors to 1031 their proceeds out of the fund when we begin to dispose of properties. And so that's the reason we're using DSTs in this case. We're going to be the test case. And again, this answer may leave some people behind, but our plan is to take our carried interest in BIs and 1031 them. Actually, what we do with those is we roll them into the next group of land positions that will feed a future fund, because we land bank all the land for our funds to avoid our investors taking the raw land risk and the 2-year wait it takes to get permitted and ready to actually put a shovel in the ground. So, but the reason we're using DSTs is to test the theory of being able to 1031 proceeds out of a fund vehicle like this. The nuances in terms of operations, it creates a little bit of complication because you have to have a master tenant and some other things, but the way all of that's structured, and I won't try to get into that on this call, the master tenants are owned by the fund as well, and so there's really no impact on the economics to the investors.
Okay, so just to clarify, it has nothing to do with doing like a 1031 into it, like into like a DST. It's to set up the option to potentially do a 1031 once everything exits. And so even as an LP, I could potentially benefit from a 1031 on the exit?
Yes.
Wow.
We're not offering that in this fund. It is a structure we're testing from a tax standpoint because we don't want investors taking that kind of risk. And then the other rabbit out of the hat, which is maybe a bridge too far, is can you 1031 out of this fund and into a subsequent fund, so that our LPs would have the opportunity to do a tax deferral and roll through a series of investments and put that money to work. But again, I didn't stay at a Holiday Inn last night, and I don't have an LLM in tax, so we'll see how that goes.
I was just curious on the DST, because typically if you're going to do a 1031, you own title in a property, you're on the deed, and then you roll into another property that you're on the deed on. With a fund, your structure is an LLC, so people are buying into the fund as participants, limited partners. They're actually not named on the deed, right? You're buying into the actual LLC. So I'm just interested to see how that would work on the back end. And maybe those are details that haven't been ironed out.
Yeah, the DST holds the title to the property. So it's titled it's the SPE that's holding the asset. And then the DST is wholly owned by the LLC. And again, the theory is you can survive that transition, but you have to make sure at the end of the day you're a like kind and you sort of fall within the guidelines. And that's where the gray area is. And that's why we're going to kind of test it out here and see. But we're doing that at no added cost nor, sacrifice of economics for the investor. So it's a creative structure that if we can figure it out, and we have some really bright tax guys based in Texas, that if we can figure it out, our hope would be at some point to be able to offer that 1031 opportunity to investors.
And if it doesn't work out, doesn't matter. I mean, it does matter, but it would just be like any other fund that we might invest in where, we don't 1031 and you just have to pay taxes or handle the taxes in the same way you would with any other fund. There's no downside to setting this up if it doesn't work to the LP.
Yeah, I want to be really clear. LPs do not have that opportunity in this fund. This is sort of a test structure, but we're doing that test without any cost or lack of economic benefit. It has zero impact to them. A DST in this structure for them is exactly the same as an LLC would be. So there's no downside and there's no cost to them. As we put this together, it was something we were very interested to see if ultimately one day we could offer a unique opportunity to investors. We use 1031s. We own a ton of land, and as we roll through that land, we tend to use 1031s to move, to buy the next group of sites that we're going to develop. And so we're a big believer in the tax deferral and the power of it over time, and we want to try to figure out how to provide that benefit to the investors at some point.
Paul, the PPM mentions the use of credit facilities can borrow up to 30% of aggregate commitments. Can you explain why that would be necessary for the fund to utilize and what additional risks that might pose for the limited partners?
Yeah, we're past the point, Paul, where that would even be a possibility. The legal counsel for the fund put that in there. If you're familiar with them, they're called subscription lines. And, you're really sort of peeling back the veil on fund management here. So the investors are getting an interest in education. But when we were in an interest rate environment where rates were at 4%, if I can use a credit facility like that and use the commitments of the investors as collateral for that facility and borrow money at 4%, that's less expensive than paying investors a 7% pref. We never really considered it. We didn't even explore it. The attorneys put it in there to give us the option if we felt like we wanted to at any point, but that horse has left the barn. So, but that typically what you do in that situation, if you had, $50 million of commitments, instead of calling some of that capital from the investors, you could use those commitments as collateral to borrow up to 30% of that amount. But we did not do it and don't plan on doing it. So.
Understood. Thank you.
Excellent. Paul, I'd like to ask about capital calls. I think in the PPM, it mentions that maybe, or it seemed like perhaps all the capital wouldn't be called that I commit initially. So if I say I want to invest $100,000, maybe all of it isn't called at once. Can you address that? And then also, have you ever had a capital call that exceeded the unfunded initial commitment, meaning you invest 100 and then you want more later? So can you answer both those questions?
First of all, we've simplified, not by planning, but one of the more complicated things for high net worth investors in a fund like ours who aren't used to a capital call structure was kind of getting used to that whole idea. We've now actually called all the capital from the existing investors. So any new investor that comes in will write a check for 100% of their commitment at subscription, which is a lot more common in single property deals and most high net worth investors are really used to anyway. So that complication is now sort of out of the way. To answer your question, we do not have the right to call one more dollar from investors than they have given as their subscription commitment. So there is no open-ended exposure. I guess it would have been possible that we wouldn't have called all the capital, but I can't imagine a scenario in which that would have happened. But that's now really off the table because we're at 100% called on the capital that's been committed to the fund. The last capital call went out in the last week and a half. And that's because, as I said earlier, we've got 4 properties under construction and a 5th that'll start in January. So we're really hitting the point where that cash is going out the door really quickly on these properties. It takes us about 6 months from first shovel of dirt to CO to get a facility built and ready to go. So they move quickly, and so they absorb that equity component, at the front end of that process.
Just so listeners are clear, when we're talking capital calls here, we're talking about capital that you've already committed, you just haven't sent it all, that maybe in the past you might have asked for part of it and then the rest later, not capital calls where you're putting in more than you initially intended to. And Chris, you're up. We got probably a couple more questions each.
It looks like most of your expertise and a lot of your core operations is in Texas, I believe. And I know part of this fund is focused in Florida. Can you talk about the experience you have in Florida, and correct me about any of your guys' other projects you have, but just your experience in Florida and how you're scaling operations out there?
If we had the map up, you could see, I can't remember the exact number, Chris, but I think it's probably close, somewhere between 15 and 20 properties we've developed in Florida. So this is not our first rodeo in Florida. We have 3 properties, existing properties right now in Florida, all sort of in that same Central Florida market. Tampa, St. Pete, Sarasota, that sort of part of the world is where we tend to focus in Florida. We have been very Texas-centric. It's one of the things that is gradually changing. Our market focus in this fund included Florida. We actually have a property in the Carolinas that if we wind up raising a little bit more than we think we will in this last quarter, we'll probably add it to the portfolio. And our longer-term vision is really to be Carolinas through Florida into Texas. So probably skip over Louisiana. No offense to people from Louisiana, but not ideal markets for us. But Alabama, Georgia, the Carolinas, Florida, and Texas are markets that we're currently looking in. The one difference in Florida is that all the Texas properties are built with dedicated resources. We control the construction crews that do that vertical and horizontal construction. In the past, we've tried to do that in Florida. To be honest, it doesn't work very well. Shipping guys, that 1,000, 1,500 miles from home, putting them in a hotel, just doesn't work very well and ultimately doesn't really give us any benefit. So we have partnered with a couple of really good GCs in Florida, and we'll use a third-party contractor in Florida for the construction, which is what most other folks do. We just have the advantage in Texas of not having to do that. We're very comfortable. We have property managers and regional managers in Florida on the operational side. And so, that part of it, once we get a property up and running, is not a challenge at all. Construction, Cal USA, who will be the contractor on Highway 41. I just exchanged emails with them this morning because we're about ready to kind of go to the next phase there. They've done some initial grading, but that's kind of ramping up. They've built a phase 2 on one of our Florida properties and built another one. So we've got a good experience with them. They're a good contractor. We're comfortable with them.
Are you doing feasibility studies on all the projects that you're doing in Florida, it being a slightly less comfortable market for you? And are you still able to build at that $105 square foot number?
Our cost is a little bit higher than that, Paul, just because of the cost of a third-party GC, but we're still, it depends on whose number you use, right? But I think we still feel like we're 5 to 10% below. We can deliver a project 5 to 10% below any of our competitors on the development side. We do internal feasibility studies. There is so much data available, readily available. We use a couple of different services where we can look at market demographics. And as you know, in self-storage, it's really a micro market. We look at 1, 3, and 5 mile circles around the property, and then we'll go out to a 10-mile view. But 90% of the time, you're not going to attract a customer outside of that 5-mile radius. And we look for traffic counts on the locations. Highway 40, we refer to it as Highway 41. The Florida project that we're doing literally sits at the intersection of Highway 41, which is a major north-south thoroughfare. It has great visibility, and the cross street there is really strong too. So we did not commission external feasibility studies. It will sound a little bit arrogant. We've been doing this long enough that I think we're fairly confident we can look at a market and do the homework and get comfortable with whether a site is a good site or not. And like I said, this business started from an investment standpoint. John Muick, our founder, was an IBM engineer for 15 years and sort of migrated into real estate and found storage and fell in love with it. And for him, the initial deals that were done were bringing investors in to sort of just extend his own capital. And if you look at our commitment to the fund, we still function that way. We're going to be the largest LP in the fund. And so we're taking risks right alongside our investors, so we feel real comfortable with the markets we're in. That was sort of a winding answer there. Apologies.
No, that's great. Thank you. Regarding debt structure, Paul, I think I read 5 to 7 or 6 to 8 year maturities, plans to sell 4 years thereafter, no prepayment penalty, I'm guessing. But just as far as the terms go, I saw that they were kind of unique, at least to me they were. It was SOFR plus 2.5 over the prime rate plus 3/4. Who are the lenders that are lending on this type of stuff, and what kind of a structure is it?
First of all, our target is a 70% loan to cost. We get that in most projects. Occasionally we get a tick above that. Occasionally we get a tick below that, sort of depending on how the numbers fall. As you, I'm sure, know, in today's world with rates a little elevated, the banks are very DCR. They're really focused on cash flow coverages, and that can push that number up or down just a little bit. But our typical terms are 70% loan to cost. We need at least a 24-month interest-only period. We typically can get 30, but at least 24. A 25-year AM beyond the interest-only period, and like you said, anywhere from a 5 to 7 year term on the loan. That's what we've done historically, and the lenders are traditionally regional banks. As we put this portfolio together, we looked at some private equity sort of backed debt. There's a lot of it out there. It's simply too expensive and too constraining. I could go back and look, but I think I don't think we have a rate in the portfolio today that's higher than Wall Street Journal Prime plus 50 bips. And most of them are either at prime or prime plus 25 bips. So although the rates aren't what they were a couple of years ago, and we'd certainly love to see them lower, we've been able to get rates that make the deals work.
Excellent. Well, thank you very much, Paul. We appreciate you being on and appreciate you answering all the questions. We're going to ask you to kind of step out here, and then the three LPs, we're gonna dig into it and see what we think. So thank you very much for being here.
Jim, Paul, Chris, it's been a blast. Thanks so much for having me.
Thanks, Paul. It was awesome.
Thanks, Paul.
So now we come to our favorite part where the three of us get to kind of chat and figure out what we think of this deal. Now, just as a reminder, we aren't here to make recommendations. We're here to provide additional insights into the opportunity. And, if you're considering investing, we strongly recommend you make your own conclusions, of course, but this is intended to help you out and maybe just show you how we're looking at it as LPs who've done a few deals in our past. So the first thing is, Chris, Paul, red flags. Do you see any red flags in this deal that make you nervous or that you'd ask and get more information about? We'll start with Paul.
No, I wouldn't say I saw any red flags necessarily. Chris and I were on the same wavelength there regarding the DST and the master lease structure. I think he answered it pretty well, and I understand what they're trying to do. What I would want to dig into a little bit more is just, are there any legal ramifications or implications to passive investors if that structure is in place, which it is. So it doesn't sound like it, but my knowledge of DSTs, and I've never participated in one, is that they're very fee heavy. You design them so you can avoid paying taxes at the time of sale for a 1031 exchange. And it sounds like they're not accepting money from 1031 exchanges. They're talking about rolling it out of the fund into another fund. But usually there's got to be intent to invest if you're a 1031 exchange. And with a development deal, it could be a little bit dicey because the intent is really to sell, even though they're maybe holding it for 4 or 5 years. Maybe they could get around that requirement, but also just that if you're rolling from a fund to another fund, frankly, there's just a lot there that I don't necessarily understand just from reading the documents. So I'd want to look into that potentially a bit more, but that's really getting into the weeds. I wouldn't say that's a red flag. And I think he answered it well. And it probably is exactly what he stated it was. The only other thing I saw in there that, isn't a red flag necessarily, but I don't love is the GP catch up. And a lot of GPs do that, right? They pay the preferred return and then they go ahead and they pay themselves a catch up once they've met that preferred return before the waterfall hurdle kicks in. So they're going to pay themselves 30% of that pref as soon as they paid the pref. So some would argue that that's not a true preferred return, but I'm in favor of, once the performance is there, the GP team being compensated for executing. So no, that's really nitpicking, I would say. Nothing that really stood out.
Okay, Chris?
No, I have no red flags and really echo Paul's comments on the DST structure. And one thing I'll add on there is I'm incredibly intrigued to see if they can pull that off. I spent a lot of time personally trying to figure out how to do like creative 1031 stuff and brick walls I keep hitting into after some legal fees. Obviously, want to dig in, as Paul said, to understand the structure some more, but I think that's just a nothing burger. I have no red flags, and I really just like their overall attitude and approach on, always going to have to add value, it seems like, and, just being very proactive in how they're structuring things and, where their business is growing. I
also don't have any red flags necessarily. I think the one thing I would maybe ask a few more questions about are the buildings in Florida where they're doing it in a different process, right? They're not using their own contractors. They're hiring GCs. So I'd want to just dig in a little bit. They have properties already in Florida, so they've already done this, so it's tested. I might just ask a few more questions about that. And then the only other thing is, people make mistakes. In my reading of it, there was a difference between the PPM and what was in the offering, the pitch deck, which is something I always look for, and I was surprised to find it. But in this case, as he said, it doesn't really matter because it's just the first 2 ways you're paid, and they just swapped them, so that wasn't a big deal. So I agree, no real red flags on this one. But as far as, and Chris, you started it, so I'll go with you on the favorite parts of the deal. What did you look at that you really liked about this deal?
The two big things I liked about them is their track record being the number one thing. I think they're 30 years in the business. And in their earlier presentation, talked about the 3 distinct market cycles. And I liked how in the 2008 great financial crisis, their plan was to sell. That's always plan A. And they had to pivot to plan B because of market conditions. And they're able to sit there and just clip coupons. Now, while that was not the plan A of exiting the property, hey, if plan B is, hey, we sit there and we collect a monthly, quarterly, distribution, that is an amazing plan B while a lot of other projects are, going sideways or going to foreclosure. So I absolutely love their track record and the fact that they were able to handle when the market just kicked everyone in the face 15 years ago.
And they proved it, right? Because I've had other operators who said, hey, we have a plan B. If the market changes, we'll do this. And as I found out in 22 and 23, the market changed and they didn't do that, right? They just folded and said, give me more capital or we're selling the property. So I agree with you. I like that it's a tested one. So keep going. I didn't mean to interrupt. I just wanted to add that context.
Yeah. And the second thing I'll add on there was just, I think he said they're going to do about an 8% total co-invest, $5 or $6 million, and they're personally guaranteeing a lot of the debt at the deal level. So the personal guarantee and the higher type of co-invest, I love seeing that for all obviously the skin in the game, and they're going to care a lot about the deal performing to make sure that they get their money back and none of their personal assets are taken back. So I really like that structure, and they have so much skin in the game.
I completely agree with that one. That's one of the ones I wrote down there too, because not only are they putting, I think he said $6 million into a $40 million raise, right? That's significant. That's more than, all the fees they're collecting and everything. That's one thing you look for. But then guaranteeing the debt, that's just another bonus. So Paul, I assume you agree with that part of it, but do you have other things that you like about this deal?
Yeah, absolutely. I mean, I definitely agree with both you guys on those fronts. As far as the asset classes in general, I really like industrial flex. That's going to be 40% or so of this fund. I know specifically around my location, there is just nothing for lessees to find to actually get into. And you're thinking about like the mom and pop or the franchisee owner that maybe needs some office space in the front to do a small team meeting before they deploy into the field, and then some area for their overhead to be stored. There's just nothing. So, and it's very difficult to build today too, which leads both into storage and industrial flex, where these guys have a great competitive advantage. If they're able to build at $105 a square foot, that is an unfair advantage in the marketplace. It sounds like they have their own contractors in Texas. Maybe it's slightly more in Florida and some of these other markets that are getting into. But if they can do that, that speaks to the yield on cost piece and the development spread that Paul was talking about. And that is so critical to me in any value add deal, especially in development deals where your operating cap rate is much higher than where you would exit if you were to sell the property. That's basically locking in a profit. And I almost think of it as insurance on principle for the LP. So I love the thesis, I suppose, and I think the track record is there to execute. He mentioned that there's really no building going on because most people are having a hard time probably generating that type of yield on cost or getting loans to actually do construction or finding and sourcing land. He talked about 2026, 27, like if they're delivering product at that point, there's not going to be much to be available for other buyers. So these private equity groups are going to see their product, Class A, they're going to be attracted to it, and there's going to be limited supply, limited competition from other self-storage developers to actually capitalize on that. So, and I've heard that argument in multifamily too, where it's like, I'm not really a development investor myself. It's not one of my favorite deals because I'm more cash flow focused. But if you were talking about developing back in 2020, like everybody else, there's all these absorption and delivery problems right now, right? There's tons of product coming to market right now. There's not enough tenants in multifamily to fill it. There's not enough people renting out leasing space and self-storage to fill it. So I think that's going to shift as the market kind of goes up and down and the cycle continues here. So I think that their thesis is pretty strong, and I like their operations. Yeah,
and I'll just add, I like the land banking idea where, they've taken that risk away from the investor, as he said, but they're still, buying this land way ahead of time. So they know that by the time they're ready to develop these properties, they have the right pieces of land. So I think that just shows their whole process. So I really like that as well. Okay, so guys, if there's any additional questions, I know we talked a little bit about, we want some more information maybe on the DSTs. I'd ask about, the contractors in Florida, but are there any other questions that you might ask of AAA on this one?
The only question I didn't get a chance to ask him was around depreciation. Since this is ground up and they are selling, I'm assuming there's no depreciation. But that was the only follow-up question I had was, is there going to be depreciation as they build these assets?
I wouldn't mind looking at a pro forma if they're going to be leasing these properties up, just kind of getting an idea of, their cash flow after the development has ended. How long is the lease up period? What's the expense load? And what's the typical cash on cash returns? I think he answered that question in the 6.5% to 8% range. But how quickly do they get there? How are they kind of modeling this out? I'd like to see the underwriting.
Yeah, and that was my main question too. And it was actually on the list. We just, you kind of ran out of time on some of these. So that's when I, take to email and follow up. I have a conversation. I have a 30-minute appointment with the operator. I ask the questions and, some of these guys can talk, right? So they talk right through, and then I don't get to answer 2 or 3 of my questions because we run out of time. But it's a perfect opportunity to then send them an email and see what their responsiveness is, right? You test the quality of the communication. You also test how quickly do they respond, and that's something that's super important to me. So I don't mind holding a couple questions back, and that was one of them for me because I don't do a whole lot of development, so I don't know. There were no financials in the pitch deck. There are no pro formas. Is that something that typically you get in development deal or not? That would be the main question I would ask. And that kind of goes into then, what type of investor would this deal make the most sense for? Paul, you said you're a cash flow investor. That's where I am as well. I would like a small allocation to development. And if I was going to, do a development deal, this might be one of them because I do like this one. But Chris, what do you think about who this makes sense for?
So I'm kind of in a different camp than you guys. I'm not a cash flow investor. I call myself more of the lumpy cash flow, where I don't care about the consistent monthly or quarterly, but I'd rather have a big, multiple 6-figure, one-time lumpy cash flow, because that's fine for my personal, finances, and also most of that money is, tax-free capital gains versus ordinary income. So I get a much more favorable tax bracket on there. I'm a big fan of development. And I also think for a lot of the deals right now, as Paul, you said, with the supply and absorption problems we're having like today and the next year, and I know multifamily very well. I don't know self-storage and flex very well. I think for really good developers who are on top of their game, I think there's a really good opportunity to thread this needle in a couple years as these projects come online and there's still strong demand, but very low supply. So I like that aspect, kind of like the macro timing we're in. So I think, these types of deals for people that don't need consistent cash flow, the monthly or quarterly cash flow, and they're also comfortable with a little bit higher, risk, meaning that, hey, depending on timing, the properties might exit really well, or they might be stabilized assets for a while before they can exit.
I agree with that. And Paul, did you notice anything, like what makes AAA different, either positive or negative, from other operators? And I know you don't look at development much, but you can evaluate an operator.
Well, I've been looking at development more lately, and similar to Chris, I'm more interested in it today from a macro perspective because of the delivery and absorption issues that we've had and the lack of building that's in the pipeline right now. So I think what's different about them is they've got 30 years plus of experience. It's a proven track record. I think $450 million in real estate developed, 6 million square feet. So when you think about who do you want to put your money with, it's somebody that's been there before, that knows the asset class, that knows the market. It sounds like they're getting into some new markets, but that's okay. There's other developers out there that obviously are operating on a high volume, but I see a lot of smaller syndicators that I don't know if I'd had the trust in for this type of fund to pull it off. So I think that's what makes them different. And, they pass the gut check too. I just really like Paul's demeanor. He's a cool, chill dude and very easy to talk with. And he was very matter of fact. And we threw some tough ones at him, and I think he handled it really well.
And that wraps up this deal review webinar. A big thank you to Paul Bennett from AAA Storage Investments for presenting the deal, and to my fellow LP panelists, Paul Shannon and Chris Lopez, for sharing their expertise. We hope this episode gave you valuable insights into what experienced limited partners look for in a syndication deal, the questions they ask, and the factors they consider before making an investment decision. If you enjoyed this episode, be sure to like, subscribe, and leave a comment with your thoughts on the deal or what you'd like to see in future deal review episodes. And don't forget to check out PassivePockets.com for more tools, resources, and a free 7-day trial to join our community of passive investors. Thanks for tuning in, and as always, happy investing.